of the Board of Investments into order. In absence of Chairman Green, I will be chairing today's meeting. Before we get into the meat of it, could I ask Trustee Gatto if you wouldn't mind doing the Pledge of Allegiance? Appreciate it. Allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. All right, so AB 2449.
Thank you, Chair Jones. This meeting is being conducted as a virtual and in-person meeting, so we'll do a roll call of the trustees to confirm attendance. Ms. Ginsburg? Here. Ms. Mee? Here. Mr. Green? Mr. Root? Ms. Martin? Mr. Gatto? Here. Ms. Martinez? Mr. Jones?
Present.
And Ms. Langton? Here. Staff participating in the meeting include the following: CIO John Grable, Deputy CIO Jude Perez, Acting CEO Louis Ligo, Chief Counsel Stephen Rice. We have the investment staff presenting Vache Masarajian, Esmeralda Del Bos, Scott Drazel, DJ Acevedo, Dale Johnson, and Mike Lombardo. Consultant on site include Makita, Stepstone, Elborn. And trustees, please use your raise hand option to be placed in this queue. At this time, we ask all meeting participants to mute their mic until you're ready to speak. And now we may proceed with the agenda.
Super. Next item on the agenda would be the approval of the minutes. After reviewing the minutes, for any noted changes at all? With there being none, could I have a motion to approve?
Second. Okay. Ms. Ginsburg? Yes. Ms. Mee? Yes. Mr. Gatto? Mr. Jones?
Aye.
And Ms. Langton? Aye. Okay, the motion passes unanimously.
All right, super. Linda, do we have any public comment for today?
We do not.
All right, I missed the old public comment days. You just never knew what was going to step up to the mic, right? Okay, so now let's go on to our executive update and welcome our CIO, John Grable. Thank you.
Good morning, Mr. Vice Chair, trustees. Thank you to Mary Pugh and the Pugh Capital team for the discussion this morning at the Credit and Risk Mitigation Committee meeting. Here we are on August 13th. It's less than a month away from the Board of Investments offsite. I know that demand is high, tickets are going fast, so look forward to seeing everyone. I actually put a joke in my notes, and maybe I'll say it, that the demand is Swift-esque, you know, for the offsite. But looking forward, you know, a lot of time has gone into it, and hopefully that will be a very productive and engaging event. If we can start on slide 4. Thank you, Deb. So this slide shows notable items and themes, and this is how we will begin the offsite, is talking about the macro environment and some of the current themes. And it's a typical way that we begin the offsite, and maybe it is that much more important this year, because as I was editing the slide, the word uncertain appeared many times, and it wasn't on here as kind of an intentional stylistic tool. It was on here a lot because many of the market themes and notable items had a certain aspect of uncertainty. And I know that Mary Pugh mentioned the word uncertainty. I stopped counting, but she mentioned it several times. And so maybe that is the market theme, and the most notable item is the word uncertain, because it says a lot about the environment that we're, the macro environment that we're in now, and we'll discuss that next month. One other thing to mention on this slide under notable items is artificial intelligence. Artificial intelligence has been on the slide for some time now. We also have an offsite session dedicated to artificial intelligence. And maybe I'll make a connection to, we have a report later this morning on internal trading, and maybe we should connect the two at some point. Artificial intelligence may change or will change. I'll be somewhat more affirmative in terms of how we trade. It will have impact on passive strategies. It will change how we diligence active mandates. our internal asset management discussion should be forward-looking as opposed to a more historical perspective on the who, what, when, where, and hows of trading. So while this presentation later this morning isn't focused on artificial intelligence, we're going to put this kind of in the lab, let it stew or marinate for, a couple of years to see, as we have subsequent discussions on internal trading, what the impact of artificial intelligence is on this module of our investment operations. If we can turn to the next slide. This shows the results for major asset categories over various time periods, as it indicates on the top as of the end of July, the first month of our new fiscal year. I will focus your attention on the year-to-date, calendar year-to-date column on the bottom chart, YTD, and there, which is and also the one next to it, the one-year column for the trailing 12 months. There are lots of blue columns, lots of blue in those columns, which reflect high returns. It's an environment that somewhat is at odds with the word that I used before, uncertainty. Uncertainty, you'd think it would be more mixed as opposed to some of the darker shades of green blue, that appear. Going there to the top left of the page, global equity, it is up 11.3% and 15.1% respectively for year-to-date and the one-year periods. That's far in excess of our capital market expectations. I mean, that's, very strong returns. And once again, something that one may not expect in an environment where there is some uncertainty. Top right, Bloomberg US Aggregate Bond Index. We just spent a bunch of time at the committee meeting discussing it, and those steady returns indicated, over the 10-year period is in line with our asset allocation, the capital market expectations that the board approved a couple years ago. So if we can move to slide 8, and we'll look at the performance for the pension for the period ending June 30th, which is our fiscal year. June 2025 produced stellar returns. Well, we can see that on the next slide, but we could say on this slide for now, 2.7% is far in excess of what we expect to return in any given month. So our market value as of the end of June was $85.2 billion. Something that always puts a smile on my face is a high watermark. We finished the fiscal year, 85.2 billion was a high watermark. It no longer is our high watermark because looking at the flash report today, we're above that. So high watermarks are something that we should always aspire for, and is something that continuously makes our job of paying retirement benefits, that much easier. We finished the fiscal year, as we could see in the bottom middle, with sufficient cash at $1.5 billion. The chart in the top middle shows a growth of $1 as invested over the last 5 years, and it compares the actual results, the lightest blue, to a 60-40 equity bond portfolio called a reference portfolio, and our policy benchmark. And we can see that the $1.60 growth of $1 over the last 5 years has exceeded both the reference portfolio and our benchmark, which once again is something shows that all the hard work that goes into managing the portfolio. Asset allocation is on the right, and the asset allocation is on target. Turning to the next slide, we can see some details about the fiscal year. Fiscal year, the pension was up 9.7%. The benchmark was also at 9.7%. Longer term, the pension exceeds the actual actuarial threshold for the 3, 5, and 10-year annualized periods. Effectively, what that says is that the portfolio is doing its job given the various market events that have occurred between July 1, 2015 and June 30th of this past year. It's remarkable all that's happened, and the portfolio has exceeded our expectations once again through a good asset allocation. For the fiscal year, and this is detailed in the bottom chart, where we see total fund growth, credit, real assets, risk reduction, overlays, hedges, and other assets. All functional categories were positive. Growth was up 11.5%. Credit led the way at 16.6%. Real assets at 6.4%. Risk reduction at 5.9% for the fiscal year. The strengths of the portfolio over the last year, credit, and it's not just for the 1 year, for the 5-year period, we can see that credit was up 10.3%. Global equity, which is a component of growth, was up 16.5% for the fiscal year. That's just a whisker behind the performance of our credit portfolio. And we should not expect credit to continuously outperform global equity. That's a pretty foundational expectation of how capital markets work if equity continuously underperforms. Hedge funds, or not that equity is underperforming, but if a fixed asset outperforms a growth asset, I think that would cause us to revisit our capital market expectations. Hedge funds for the fiscal year are part of the risk reduction portfolio. They returned 7.2%, and it's fantastic when a diversifying risk mitigation strategy exceeds our actuarial benchmark. Once again, some of these numbers aren't on this, they're embedded in these, and the details will be in the quarterly performance book that comes out in September or October. And then another strength, which is in the real assets portfolio, was infrastructure was up 15.6% for the fiscal year. Some of the not so strengths for the year, and I think it's very important to discuss our not so strengths. It's easy to talk about what worked. It's harder and maybe more important to talk about areas in which we can improve. Private equity was up 3.1%. Private equity is designed to be the growthiest part of our portfolio, yet it's lagged the benchmark and has been candidly a headwind to total fund performance over the last 3 years or so. And it's something I know that the team is working hard to rectify, recognizing though that private equity has a benchmark that is non-investable. So it's something that over longer time periods is a better measure of the efficacy of that portfolio. Real estate.
Hey, John, quick question for you there. Do you feel like the mark to marking for private equity across the system, or are people still kind of, what's the affirmative word, still postponing kind of a marking of where their portfolios really are? Where do you feel like we are on that?
It's a complex question, and I think that there are 2 things that to answer that. One, private equity tends to be held at the price at which the investment was made, unless there's an event. There have been fewer IPOs and fewer sales, so the frequency of upmarks has not been as much as we've seen over when compared to 5 years ago. I think it's starting to change with the IPO window opening up a little bit. So I think that by virtue of the accounting rules, which is the second thing, the accounting rules kind of force the appearance of stability in those valuations. So I would say that and that accounting rule is kind of a gravitational force for for private equity portfolios, and then to the extent there are IPOs or other forms of exits, that's what kind of is the accelerant or force that breakaway velocity from gravity in that case. So I think that maybe we're in a period where things start to change with more transactions.
Okay, Trustee Me, and then Trustee Lemon.
Thank you for presentation. I have been waiting, exciting to see the fiscal year end and our performance as I'm reading the news of other pension funds, how they're performing out there. You answered a lot of my question before you even asked. So I did think about the private equity. I'm looking at the performance on the slide right now. The grow, right? Grow is only like functional category that doesn't meet our benchmark, and I'm assuming that's coming from the private equity. As you say, it's important that we learn, either win or loss, important that we learn as we go. And then I'm seeing like other pension fund, right, private equity, they're doing well. So I'm thinking, what can we learn? What can we do to adjust? And how do we improve from here to take the other look at our portfolio in private equity? Just apply, right? The other thing is, like for the overall performance, like first of all, congratulations. I think we do great. I also look at the overall fund, the position today. Like you say, we have 85 billion. I believe the delta from beginning of the year and now the funding grow by 6.1 billion. Is that right?
And that's something that we'll discuss, I think,
Okay.
on slide 21. So yes.
Yes. So very, excellent. And then of course, the outperforming in credit is really exciting as well. When we look at performance, it's always important, right? Look at risk and return. Risk and return always come together side by side. And then maybe some other pension fund perform better, but might be they're taking more risk. So I'm thinking on that sense, could you share the information on the Sharpe ratio on the performance to give an idea of the risk that we're taking?
Thank you, Ms. Mee. A couple thoughts on the questions and the observations is private equity is our public equity portfolio exceeded the benchmark. Private equity, and this is something that we've discussed earlier in the year when we were lagging the benchmark, private equity was more than 100% of the underperformance. And private equity has a public equity standard plus a premium. And when public equity is outperforming, it's harder for private equity, which is more measured, to outperform in extreme bull markets. But private equity has been a drag on total fund performance. Not making any excuses for it. I don't know what other plans do in terms of their private equity portfolios, be it, are they levering their private equity portfolio on top of leverage, in the investments? That I don't know. To the extent that it's co-investments, if it's venture, if it's international, I don't have an answer to what other plans are doing. The only thing I can discuss is what we're doing. I think that our co-investment program is working. It's outperforming our private equity program as a whole. And it's something that I know that Chris Wagner, Didier, and the whole private equity team focus every day, all day, and then after hours on how we improve that performance, because it's something that we take quite seriously. We want to win, not to post a number, but we want to win for the perspective of helping LACERA accomplish its mission. And private equity service is, as I mentioned, is the growthiest part of our portfolio. To the extent it's not, then we should revisit what the risk-adjusted profile of the fund. So I think that's something that we owe or will continue to diligence and look into that portfolio. As it relates to the risk-return profile of other plans, LACERA, our allocation to global equity is 28% or so.
Yeah.
most public plans are higher.
Yeah.
So when public equity is producing 15+% returns, and if that's half your asset allocation, well, that's, that's the delta. That's the difference between our returns and other returns. I would say that our portfolio is more diversified. There are more contributors to our 9.7%. And what we saw in the quarter ended in March, which was a down quarter, our portfolio outperformed in that quarter, because I think that our portfolio is of multiple notes, not one note depending upon global equity outperforming. So I don't have the exact numbers as it relates to the risk return profiles of other plans, but I think that our plan, once again, is much more diversified. And I think that proves us well, positions us well in environments where there is uncertainty in the markets.
Do you have the Sharpe ratio for our performance?
We can get the Sharpe ratio by the end of in the good of the order. I'll share what the Sharpe ratio is for the fiscal year.
Thank you so much. And maybe since we talk about other plans, I can have our consultant to share. Maybe our consultant have more information about other plans. So team, do you have information about other plans you can share? How do we do in comparison? I feel good, but how do we do in comparison with the pension fund?
Yeah, so in the quarterly performance books, there's always the peer.
Hey, Tim, would you mind coming to the mic just to make sure that our public can get the benefit of your commentary?
Thank you for your question. So in the normal quarterly performance books, we have a much deeper dive where we collect data. The current peer group that we utilize for you is public pension plans that are greater than $1 billion in assets. So we're able to look at all of the performance metrics, including Sharpe ratio and how you compare. The previous results have been very favorable. I haven't looked at what the fiscal year results would be. I'm sure on Sharpe, you're still quite strong, but we'll see that in the September books. I just don't have that at my fingertips, but all the past periods have been quite favorable.
Fantastic. I will be patiently waiting for the quarterly book. Thank you, everyone.
The Sharpe ratio is 0.72.
Oh, thank you.
Trustee Langton, did you have? You're good. Okay. All right. Thank you, John, for being responsive. And go ahead and resume.
One of the on this slide, in terms of the other not so strengths, real estate, our core real estate portfolio was down 1.5%. Non-core was down 0.9%. Both lagged their benchmarks. However, and this may be the silver lining, the restructuring is in process and is working. For the fiscal year, we sold over $1 billion gross of our legacy real assets portfolio, and the newer fund commitments we've made have been outpacing our legacy portfolio. So the newer core portfolio, for example, the newer core portfolio outperformed the legacy portfolio by 6.2% and beat the benchmark over the fiscal year.
Well, I know it would be impolitic for me to do a gritty about right now, but I just wanted to say that's good to hear, having chaired the real estate committee for a while and the painful transition through that. So thank you, team, Terry and team.
And then once again, there'll be more information in the quarterly performance book about all the various components. There's 100+ pages of detail behind what is summarized on the slide. And that will be next month or October. Slide 13. So OPEB was up 2.6% net for June. The market value was $5 billion, also a high watermark. And so we finished the fiscal year with a combined market value of assets in excess of $90 billion. I certainly like double high watermarks more than I like single high watermarks. Once again, it shows that we're doing our job. However, I'm always mindful that our liabilities exceed our assets. So while we're at a high watermark, our liabilities presumably each day are at a high watermark. So like the pension, the OPEB growth of a dollar chart in the top middle shows that performance exceeds the benchmark and the reference portfolio. And once again, we show all the numbers here, net of all fees and expenses. There's some more details on the next slide. So the table on the top is a reminder that OPEB is a more volatile portfolio. There is a higher allocation to public securities. And this goes to the question that the vice chair was asking, that the strategies for private assets compared to public assets aren't necessarily riskier. The accounting, however, for illiquid investments smooths returns and gives a sense, rightly or wrongly, about valuation stability. And so this gets to the question about when GPs, general partners, will start marking portfolios. Public securities, in contrast, price more frequently based upon market trading, market events. Private securities trade less frequently and use a variety of valuation methodologies. And this not only is a key area for this for the board, but for our financial auditors. It's a key area as they go through the audit. Fiscal year, OPEB returned 11.1%. That exceeds its policy benchmark of 10.3%. And this is consistent with Ms. Mee's question about looking in various trade publications and seeing that some plans have higher returns. OPEB has a much higher allocation to public equity, and that's basically the difference between the two portfolios. And this is what gives me comfort. If you look at the table on the chart on the top, and you can see how dispersed the returns are over the last 10 periods. Now I'm going to call kind of a game time audible and go back to slide 9. And you can see how tight the distribution of returns is for the pension. And that's a result of the greater diversification, but also the accounting. And I think that for plans that are cash flow negative, like the pension, I think having a tighter distribution of returns is something that should give us some comfort. If we can go back to slide 14, please. So like the pension, OPEB for the 10-year performance, here it's 7.8%. That's above the actuarial and policy hurdles. And it's something that we should aspire to do over every 10-year period, is to have such attractive performance compared to our benchmarks. For the fiscal year, all functional asset categories were positive, and growth had the highest return at 16.2%. And let's finish on slide 21. And Ms. Mee stole my punchline here. It's all good. So this page details the change in our net fiduciary position, the inflows and outflows of the pension. Includes benefit payments and administrative expenses, also includes investment gains and employee and employer contributions. So for the fiscal year ended June 30th, the pension generated over $6 billion of net gains. And that $6 billion of net gains is despite being cash flow negative, benefits exceed contributions, and market uncertainty. So I think that's, maybe the one number that we should all take away from this meeting, may be $6 billion. So with that, Mr. Vice Chair, I'm happy to, I guess I always say stand for questions, but I'm sitting. So I'm happy to sit for questions.
Any additional questions from my colleagues here? If not, thank you very much, John. Appreciate that. Then let's, JJ, is he in the room? Or I guess, are you doing spotlight? Okay, gotcha.
Exactly, I'll do the
Sorry,
spotlight.
go ahead, Acting Chief Executive Officer.
Okay, thank you. And again, good morning, Vice Chair Jones. Good morning, trustees. Before we do the spotlight with our member, I do want to tug on some comments that John made and appreciate the context around our fund. One high watermark, John references high watermark for us, is we ended the year paying over $400 million in benefits. That equates to about $4.8 billion annually that we pay out in benefits. And when we talk about our assumed rate of return of 7%, As John mentioned, our total fund was 9.7%. And I know John has a critical eye as well as the investment team, but I think that's something to celebrate when our members can, to ensure that our members have confidence when we talk about produce, protect, and provide the promised benefits. So appreciate the team's efforts around the fund performance, and obviously always looking at opportunities for improvement. And then also Ms. Pew Capital talked about, I appreciated the deputy CEO referencing, the people and the person, and that's our spotlight. We always want to stay grounded on our why. And today we're going to spotlight Chris Fedoroff. If we can go to the next slide, please. Chris Fedoroff is a court reporter, 27 years of service with LA Superior Courts. He's still actively employed, but I think he's currently interviewing with some of our counselors, but he enjoys, in retirement, he hopes to continue to make music in his recording studio at home, as well as spending time with his family. So again, congratulations to Chris on his future retirement, and certainly appreciate his willingness to get a spotlight from LACERA. So thank you.
Thank you.
A couple of highlights from the CEO report. We're still in the midst of safety member elections. Voting began last week. It concludes August 29th. We expect candidates to receive preliminary results the week of September 9th, and then ultimately have the Board of Supervisors certify the elections in October. The LACERA Summit is scheduled for September 18th. Look forward to hopefully some of you attending. It's the first event that we'll have all staff together, and the theme is Values in Action, and we're looking forward to cross-divisional participation and engagement for that event, and appreciate HR communications and the team working to put that event together. And then lastly, just on a recruitment update, the Chief Ethics and Compliance Officer, that's been a position that we've been working through with the ACRE Committee organizationally. We've made some progress with the county CEO. We expect that position to go through the Board of Supervisors process in this fall, and hope to start recruitment for that position towards the early part of next calendar year. So with that, I'll stand for questions.
Any questions for our acting CEO? Yeah, go ahead, Trustee.
Thank you for the report. Really appreciate it. I just want to add a minor comment from the materials that we hear in case our members hearing, listening out there, that the great news, the lifetime maximum benefit increase is effective July 2025. Is that right?
Correct. July 1st, lifetime maximum benefit increase to 1.5 million for Anthem plan participants. And we hope to see that increase in the coming weeks for the following year. So more to come.
Thank you for the excellent work there. Thank you. That's all.
Okay, thank you very much.
Thank you.
All right, so next in the program. Morning, gentlemen. All right. Morning. Yeah.
Great. Good morning, trustees. Agenda item 7A is a recommendation for the board's consideration to affiliate with the ESG Data Convergence Initiative. It's EDCI. As trustees are aware, LACERA's policies do recognize that the corporate governance practices at the portfolio companies in which we invest, as well as a range of ESG matters like workplace safety and regulatory compliance, can impact financial performance of the companies we're investing in. We have sought to take a practical and credible approach to considering ESG factors in our investment process and the due diligence, including accessing information and data related to ESG risks where it's available. This EDCI is a relatively new initiative by which private equity firms are starting to measure a defined set of core metrics on workforce issues and other ESG related matters at their portfolio companies, and then making that information available in a database for asset owners like LACERA to access and compare when they're conducting due diligence, as well as for portfolio analytics. So this was developed by industry participants, and if we can bring up slide 3, please. Move forward. The initiative was developed by industry participants, and although it's only a few years old, we've noticed that about half of the general partners that we're working with in private equity are reporting information into it. The team's reviewed the EDCI and thinks it's worth the annual price of $5,000 to affiliate with a formal affiliation here. So that's why we're bringing it to the board today. The slide 4 covers some of the basic guiding policies, including the investment policy statement's recognition of ESG risk factors. We also think that affiliating would be consistent with the strategic plan as reviewed and ratified by the board that includes accessing and making more use of ESG data as it becomes more available. And we note here that we are bringing this item for the board's consideration since both policy and past practice provide that the board approve where we affiliate with formal ESG related initiatives. So even though the $5,000 per year is arguably nominal, we do bring the formal affiliations for the board's consideration even when there's no cost. So slide 5 covers a little bit more details on the initiative itself, including that it was set up 5 years ago by a large private equity firm and CalPERS, and in a relatively short amount of time now includes 350 private equity firms and over 150 asset owners, both in the US and abroad. As mentioned, those firms are starting to measure a number of core defined metrics, including like workplace injuries, turnover rates, and then making that information available in a database. A lot of firms that we know in private equity are including and measuring other metrics relevant to the specific companies, but the spirit here is to have a core baseline of core, kind of basic metrics. So far, the initiative has over 6,000 portfolio companies reporting into it, which would enable users to compare data as it grows. And while we are members of the Institutional Limited Partners Association, ILPA, they are now administering the initiative, and Boston Consulting Group has provided on a pro bono basis the development of the software and the database. Slide 6 quickly captures our review process. We were familiar with the inception about 5 years ago, and in the normal course of our discussions and due diligence of private equity firms, we've became aware of more firms becoming more active. So at the top of this year, the team started a trial access to be able to gain access to the database and see how we might use it if we did affiliate. So I'll turn it over to Dide to cover some of the takeaways.
Thank you, Scott. Good morning, trustees. Summarized on this slide are some of the findings from our trial. It's organized into merits and concerns. We've talked about a lot of the merits, but I'll cover 2. 1, access to additional data will help enhance our portfolio analytics. Specifically, it doubles our carbon emissions coverage. Number 2, it could help us with our due diligence in surfacing insights on comparable data and benchmarking. And so that could be pretty valuable. There are 3 concerns listed on this page. 2 of them have to do with the firm EDCI's organizational maturity. First is the absolute number of metrics that are available. So there are 18 metrics that we can compare. We think that over time, there could be additional metrics added to the database for us to compare. And it doesn't prohibit us or GPs from looking at other metrics anyway. The second item is that there's limited breadth in some of those metrics. Some GPs don't report the data immediately, but we've gained comfort that there's momentum in the adoption of EDCI. And even some of that information, as noted in the first strength, is valuable to us. The last one has to do with a potential conflict of interest with the Boston Consulting Group. BCG primarily advises corporate leadership on strategy and turnarounds. Access to this database may be used for other reasons to help their main business. But as Scott mentioned, ILPA stepped in as a secretariat to help enhance governance. We also are heartened that there are talks about enhancing governance, and certainly if the board approved, we would try to push governance even further. Should the board approve our affiliation to EDCI, it would align with the board ratified strategic initiatives listed on this page. It would help us optimize our investment model, enhance operational effectiveness, advance TIDE, and maximize stewardship. Given this alignment, we ask that the board approve our affiliation to the ESG Data Convergence Initiative. Thank you. We'll stop here for questions.
Super. Do we have any questions from my colleagues?
Yeah, thank you for presentation. I really enjoy reading the whole package of materials. I think this is great. Just a couple of things I want to know. I know CalPERS is the founder of this, right? Just curious, are there any other pension fund being members at the moment? Like US pension fund?
Yes, there are 150 asset owners, both in the US as well as Europe and elsewhere that are active, including a number of other US pension plans for sure.
Fantastic. About the data, the portfolio company, I see is a large number, right? 600 something portfolio companies in the database already?
Over 6,000.
6,000. Oh, I missed one here. There's a huge difference. Are they a public company or private?
So all of the portfolio companies that private equity firms are reporting in are the firms that they own, so they're privately held. So this is particularly addressing a gap in the data availability between public markets and private markets, since public market companies do have broader reporting requirements. So this is one means by which we can access a little bit more insight on the companies that we're invested in private markets.
It's excellent because private equity, private company, we don't have a much data, right? So there's the other source of data we can do our due diligence. I'm hoping this can help us mitigate the risk in private equity investment, because we have, if I remember correctly, do we have 46% allocation there, 80% of risk in private equity? Maybe I didn't get it right. So mitigating that risk is critical. So I'm glad to see that we have one more source of data to do our due diligence. So one last thing. I also read from the materials that this is going to be integrated to Thai, which is I'm excited about. So no more question. I fully support this. And thank you.
Okay. Any other comments, one way or the other?
I'll make
Go
a
ahead,
motion
Trustee
to
Martin. Thank you. Do
um,
I have a second?
approve. I'll second it.
Thank you. Ms. Linda?
Ms. Ginsburg,
Yes.
Ms. Mee,
Yes.
Mr. Rude, Mr. Gatto, Mr. Jones,
Aye.
and Ms. Langton.
Aye.
Okay, the motion passes unanimously.
Thank you very much. Scott. We have another presentation coming up now, the reports, internal asset management update, as me, Vachi Dale, and Tim.
My notes aren't coming out there.
Good morning.
Yep, good morning, everyone. And okay, you're up. Thank you. Appreciate it.
Great. Good morning, trustees. Today we're presenting the 2025 update on internal asset management. Our objective on slide 3 is to provide you with a refreshed analysis on managing passive public market investments internally. Now, this update builds on work that we've done in prior years, starting with the board inquiry on the subject at our 2018 Board of Investment offsite. We've run the analysis, and as in previous studies, we reaffirm that the implementation of an internal management model is not a cost-effective use of our staff and resources. We will share with you in this presentation that the direct costs are estimated to be double those of our current passive management fees. And because passive internal management is not skill enhancing, it's largely a heavy operational exercise, we would also forfeit the economies of scale that our external passive managers already provide at a very minimal cost. Instead, LACERA has achieved substantial value through several intentional actions. If we could just go to the end and preview slide 19, where we show, a little bit more, there we go. Here we show multiple examples of how LACERA aligned with its strategic initiatives, such as optimizing our investment model and strengthening influence on fees and costs, are adding significant value to the total fund. Now, these efforts have generated billions in gains, millions in savings, without the added operational burden of internal passive management. Bache will review this slide in more detail later in the presentation, but if we go back to slide 3, we'd like to state that in short, the most effective path forward remains leveraging our current model while continually innovating in ways to deliver measurable results to the fund and to our members. Now, with that as a preview, the balance of our presentation will cover how we arrived at that conclusion, including a background of information, assessment of our considerations, cost-benefit analyses, and some key takeaways. Right. Go to slide 5. First, I'd like to pause and define what internal management is and why do plans like LACERA consider it. The circle in the center contains the definition of internal management, which means that internal staff become responsible for investment functions that externally hired portfolio management firms currently perform. Things like trading, pre and post trade compliance, and settlement. Now, plans pursue this for various reasons: to reduce fees, increase control and customization, align portfolios with investment frameworks, or develop in-house skills. As I previously noted, LACERA has successfully achieved these goals without the need to manage assets internally. And although the concept of internal management is not new for public pensions, the key question has always been, do the potential benefits outweigh the costs and risks? And that's what we're going to explore today. Now, as a quick note, for this presentation, we did focus on a review of public market passive internal management, which serves as a logical starting point and foundation for initiating any internal management program. The spectrum of internal management starts from purely passive or index mandates replicating a benchmark to active mandates that make security selection decisions on elements like geography and sector relative to a benchmark. If we move to slide 6, we can cover the history. At LACERA, internal management has been a multi-year discussion, and here in the spectrum, we can show how that's evolved. In 2018, as I mentioned, the board requested a study of the merits and the risks of internal management. In 2019, we conducted a peer review and also an independent feasibility study. In 2020 and in 2021, we held offsite discussions about the topic. And in 2022, we had a comprehensive analysis, which included lessons from the pandemic. And also at that time, the board approved a recommendation to pause pursuing internal management. Today, we're revisiting the topic with updated data and inputs. I'm going to now pass the presentation to Tim, who's going to cover some information on peer review and approach.
Great, thank you very much, Esme. So what you can see here, looks pretty similar to some analysis that we've performed for other governance exercises for LACERA. Essentially, this is putting the periscope up and surveying the landscape. We have a peer group that we utilize on a consistent basis. It's other peer plans that are 50 billion and up. One unique characteristic of LACERA, you're the largest county plan in the country. So this is generally comparing yourselves to other state plans with a couple of organizations in there, like the New York City plans. But generally, your peer group is comparable with that one caveat. So we looked at it and we basically went through all of the publicly available data. Some of these are Makita clients, so we have particular insight into a few of them, but most of them are not. And what we found is that about 2/3 of the universe does in fact use internal management. And so that's a useful data point. It says this is a fairly common practice. The flip side of it is 1/3 of your peer organizations also do not utilize internal management. So maybe when we go to the next page, we can think about some of the reasons why this universe is particularly split. And it's not included in this presentation, but when I was listening to Mary Pugh speak and doing a little bit of story time, I thought I'd do the same. So if we went back in time to, let's say, the year 2010 2004, so roughly 20 years ago. What things were different in the landscape than how things operate now? Stocks were still priced in 16ths, so instead of trading at penny increments, you actually had to do some math with a calculator and figure out whether I wanted to pay a 16th or not. So you had really wide bid-ask spreads. Commissions that you were paying for trading were 10 to 25 cents a share. Now they're a penny, or large institutions oftentimes don't pay any commissions because the street is willing to buy their trade flow. So if you're a very large institutional trader, your commissions that you're paying to the street are incredibly low. You also have very large asset managers like those that you utilize in your passive implementation that are just using their own trade flow, their liquidity on one customer buying and selling, and they're not actually reaching out to the street at all anymore. When I first started on Wall Street, if we wanted to make a trade, I walked down and I talked to Joey in the trading room. Joey would pick up a phone and he would talk to some other person on the other end of the phone line. And that's how you would do your trading. Now it's multiple different electronic systems that you're using. You need to have really advanced systems to do all this, because instead of just looking at the ticker tape going across, you're now looking at whether you should be executing orders using VWAP algorithms or other trading mechanisms, dark pools. All of these things didn't exist. And that's really the time frame under which a lot of your peers did implement internal trading, right? So they may have started back in the 80s and 90s, when portfolio allocations were largely just simple stocks and bond allocations at that point in time. Rather than paying for active managers to manage those, they were able to achieve tremendous cost savings. Passive management was also a relatively newish phenomenon. Vanguard has been rising and growing assets really since the 80s, but I would say the 90s was kind of the big inflection point on when institutional investors started adopting passive management, and that's just continued to grow. The other major change has been the use of alternatives in portfolios. So while internal management made sense when 80 or 90% of your portfolio was made up of simple stocks and bonds, now institutional allocations include 30 or 40% allocations to things like private equity, infrastructure, other assets that you really can't utilize that same sort of trading dynamic. You can have internal capabilities such as what you all have adopted on the co-investment front, but the landscape was really, really different. And I think that's the main point. So when we did a little bit of deeper digging, in the peer group, there's one institution that we're aware of that adopted internal trading in 2015. And as far as we can tell, all of the other organizations that are utilizing it have decades of that past practice. So I think with all of those considerations, maybe that paints the picture on the analysis that your team's presenting here today.
Thank you, Tim.
With that, I'll turn it back over to LACERA folks.
Yeah, thanks for the trip down memory lane, Tim. So in recent years, LACERA has succeeded in negotiating lower fees from external managers, achieving meaningful reductions across both passive and active mandates, which makes the allure of internal management even less attractive. For example, since 2018, we've reduced our passive management fees by 15% and active fees by 17%. Our global equity fees have decreased even as assets have grown. And in 2023, we secured a 35% reduction in passive management fees for the OPEB trust. As part of the exercise, we also spoke with peers who manage assets internally. And the message that we heard aligns with what Tim had just commented on, which is internal management was implemented 20 plus years ago when passive management fees were much higher than they are today. We move to slide 10. Also to the point of evolution that Tim had commented on in the peer universe, LACERA has experienced the same. Over 2 decades through strategic asset allocation studies, we've reshaped the pension and OPEB trust portfolios, adding more private, less liquid assets to enhance diversification and better manage total fund risk in a lower return environment. If we focus on the 2005 pie at the top and in that green section, we see that the pension held 16% to private markets in the total fund, while today in 2025, that green portion of the pie constitutes roughly 45%. This evolution is very important to the context of our conversation today. Our portfolio mix has more than doubled its exposure to asset classes that are modeled to provide a wide range of return and active return, further reinforcing that our staff is focused on performance and risk management of complex assets and not on index mandates that provide little to no alpha or excess return. On that, we move to our assessment. We've examined what it would take for LACERA to manage passive public mandates in-house, from operational infrastructure, compliance, staffing, and governance. And Dale will now guide us through each of these dimensions, highlighting the topics for LACERA's consideration in adopting internal management.
Thank you, Esme. Good morning, trustees. First, we're going to focus on the necessary operational infrastructure required for internal management. On the left side of the slide is a task and process chart. So the green boxes and text on the left side of the chart are functions that LACERA already performs in its day-to-day operations of the pension, such as working with our custodian, performing risk management, preparing and distributing reports, and abiding by investment policies and guidelines. The right side of the chart is what LACERA would need to implement for internal management, whether passive or active. It's essentially the foundation for and the life cycle of portfolio management. So going around the clock from about 1 o'clock position, policies, procedures, and systems would need to be updated and procured to facilitate the portfolio construction and management process. As Tim alluded to, additional specialized tools and systems are required for trading processes summarized in the boxes from 3 o'clock to 6 o'clock. Moreover, these tools and systems vary by asset class, and there is currently no one-size-fits-all or beginning-to-end solution. Currently, all the functions within the brown trapezoid and the brown boxes are performed by LACERA's external investment managers. Internalizing these functions would require additional resources such as systems, processes, and personnel to support the internal management. However, as John discussed in his CIO report, the broader impact of artificial intelligence is yet to be determined, and in time could shift this diagram in unforeseen ways.
Trustee Me.
Thank you. I just want to go back to the early slide. This is a wonderful slide to help me understand the operational model here. Just have one question about our co-investment program. I know that's kind of new, and then we pride ourselves as investor in the co-investment program. So how does it operationally different for co-investment comparison of other investment in this chart?
Yeah, so for the core co-investments, it's usually focused on one investment, where in this sphere, whether we're talking about public equities, it could be building a portfolio out of about 8,000 public securities, or in fixed income, where Mary Pugh talked about, it's also 8,000 fixed income. So their focus is on one potential individual investments. We're building out a portfolio here. We'd be evaluating thousands of securities to build a portfolio that properly reflects our risk profile and expected return.
Got it. So co-investment more like we do it in private equity and a single deal. This is credit
private asset. It's more appropriate in the private asset classes.
That makes sense. Thank you so much.
If I could just weigh in on that, there's also one buy in a co-investment program. So you're evaluating at the point in time that that deal is presented to you. And then the exit is more or less dictated by whoever you're partnering with on it. So you only really have one decision point when you're managing securities portfolios. Every day comes with hundreds of buy and sell the decisions. You're collecting coupons on the bonds that you own. You're collecting dividends. You have to pick how to reinvest those. It's literally thousands of securities times hundreds of transactions per day.
All right, go ahead, Dan.
Okay, thank you. Risk management is a keystone for internal management. LACERA currently has and continues to build out a robust risk management system comprised of an oversight framework, compliance, internal controls, and incident readiness, as shown on the panels of the umbrella. However, adding internal management would require consideration of additional potential risks. Some key areas of focus are noted under the umbrella that would need to be addressed. Note this list is not exhaustive. In the operational infrastructure slide, we noted that additional policies, tasks, systems, et cetera, would be required for internal management. On this slide, we highlight that internal management would likely require additional personnel across the organization. Within the investment team, additional personnel would be needed to provide backup resources and to support some additional functions that would be essential for internal management. And beyond the investment team, positions to supplement existing personnel would likely be required for accounting, legal, systems, and maybe even HR. As alluded to in previous slides, internal management adds an additional layer of operations beyond what LACERA is currently used to and structured for. So this slide provides examples of consideration within 4 key aspects of the organization, including fiduciary duty, reputation, systems and operations, and governance. The lists within each are not exhaustive, but illustrative of potential areas of risk to LACERA and are currently encumbered by external investment managers. LACERA's focus on managing and mitigating these enterprise-level risks are central to the consideration of internal management and the potential impact on the organization. I'll now pass it to Vache to talk about the cost-benefit analysis.
Thank you, Dale. And good morning, trustees. Esme asked the fundamental business question, do the benefits outweigh the costs and risks? This page addresses the costs, and the next page will cover the risks. Here we summarize the direct costs of internal management and compare those costs to what we currently pay our external managers. To properly manage assets internally, we need 4 things: people, data, systems, and process. We made assumptions for the people, data, and the systems needed and projected the costs. The column on the far right shows what we currently pay our external managers for various mandates. And the second column from the right shows the costs of managing those assets internally. Each row represents a different set of mandates, reflecting a logical progression from simplest to most complicated strategy. Within each row, the first column shows the bond mandates, and the second column shows the equity mandates. So for stage 1, in fixed income, the simplest strategy to bring in-house would be our TIPS, or Treasury Inflation Protected Security, as well as our long Treasury portfolios. It's simple because there's only one issuer, the US Treasury, and there are fewer than 100 securities. On the equity side, the most straightforward strategy is domestic indexing. Based on our assumptions, the cost of managing stage 1 mandates internally would be $4 to $5 million per year, with about 80% attributable to labor costs and 20% to data and systems. In comparison, we currently pay our external managers $1 to $2 million per year. Therefore, based on our cost assumptions, internal management of these strategies would not be cost effective. On the second row, stage 2 adds the costs for adding the bond indexed assets that track the Bloomberg Aggregate Index, and on the equity side, the domestic factor-based strategies. Finally, in stage 3, we see the comparison for adding the non-US developed equity indexed assets. Again, internal management would be more costly than external management, with the cumulative cost for all 3 stages in the $9 to $10 million range, roughly twice the cost of external management. So in all 3 phases, the outcome is the same. Internal management would be more expensive than what we currently pay our external managers. As Esme noted, we've been very successful in negotiating down the cost of external management. Therefore, it's difficult for internal management to be less expensive. Next page, please. In addition to the direct costs, there are indirect costs related to building the necessary infrastructure needed to manage and mitigate various risks. Currently, our indexed and systematic factor strategies are managed by industry-leading external managers that have deep resources and benefit from economies of scale. These managers have trillions of dollars under management, they have cutting-edge technology, large research teams, and robust infrastructure with the necessary redundancy of critical systems to provide backup in case of a disruption. These resources supplement the external manager's indexing business, and their cost is subsidized by their active assets under management. For example, our external managers deploy the combined benefit of the trillions in assets, the analytical systems, and the research teams to minimize tracking error for their index products. Keep in mind that just 1 basis point of tracking error in a $15 billion portfolio amounts to $1.5 million per year. If we manage these assets internally, we would be transferring the investment risks plus all the enterprise level risks that Dale mentioned from our external managers onto LACERA. Recall that the objective of our passive public market mandates is to faithfully generate market returns while maintaining low costs with minimal active risk. Our external managers have succeeded in consistently delivering these. The key point is that instead of trying to compete with external managers on commoditized passive mandates, LACERA is deploying our resources on other ways to add even greater value and achieve cost savings, as we'll see on the next page. The investment division's 5 strategic initiatives form the framework for adding value across the entire portfolio in both public and private markets. On this page, we've listed 4 of our 5 strategic initiatives, and we highlight a few of the ways that staff or LACERA adds value. For example, at the total fund level, the overlay program has delivered approximately $600 million in gains. Within global equities, the equity currency hedge has delivered about $1.69 billion over the past 15 years. Note there, by the way, the typo there, the comma should be a period. It's 1.69 billion. Within private equity, the co-investment program has delivered about $350 million in added value. And in the credit portfolio, we've saved hundreds of millions of dollars by adopting a hard hurdle performance fee structure and investing via dedicated managed accounts, or DMAs, which enhance control and transparency while reducing costs. In each of these cases, we produced a much higher payoff than what could be achieved by internally managing passive assets. The last 2 examples highlight that LACERA is focusing its efforts on more fertile areas, the complicated parts of the portfolio where the potential to add value or reduce cost is much greater than what is offered by internal management, where external management fees are already very low. Next page, please. To summarize, internal management would be a major undertaking that impacts the entire organization. It's not just 2 people and a Bloomberg terminal. It requires a commitment of resources, not only from investments, but also financial accounting, legal, compliance, systems, human resources, and of course, with proper governance oversight by the Board of Investments. Is it feasible? Yes, certainly. But would it be practical and worthwhile? Our analysis reached the same conclusion as prior reviews, that managing our passive public market assets internally is not advisable because both the costs and risks are higher. The good news is that LACERA strategic initiatives are providing a guide and framework for adding even greater value throughout the entire portfolio. That said, we think it would be prudent to revisit the merits of internal management periodically, potentially following the next strategic asset allocation review. With that, we'll not stand but sit for questions.
Yeah, let me compliment the staff, because I think from a board perspective, that's exactly kind of what we want, right? This was brought up, I can't remember if the history of it was by Herman or maybe it might have been Sean Keogh back at the time. And, the context was different. Management did exactly what we'd expect them to do. In addition to taking a look at it, looking at the delta between external management fees and the costs, then you went about following one of the things I remember John saying ever since I've been on the board was that the reduction of fees is a consistent part of our strategy overall. So being able to use the context of the report to be able to then go in and negotiate lower fees is just, again, I think it's the optimum scenario of how the board and senior staff is supposed to work, and just appreciate you guys continue to revisit this to see if we can optimize that. Trustee Langton.
Thank you for the presentation. Very informative, very convincing. It was convincing with the PowerPoint too, just the slides. Thank you. Why do we need to reconsider this? I mean, it seems there's just, sure, is it feasible? I guess, but do we need to reconsider this after another strategic evaluation or asset allocation? I mean, I feel like the toothpaste has already come out of the tube. We're not going to get it back in. So under what circumstances would we ever consider this again?
So I think it's always prudent to review things on a periodic basis because the world does change. And maybe the one thing that John hit on this morning is additional AI integration could really shift that cost and risk balance even further. So now when you look at it, just the simple example of a trade error where that liability is falling on an external partner, trade errors still do happen. They're less frequent than they were 20 years ago. That's another part of the storytelling. And perhaps with AI, you can implement internal systems and processes that would have so many redundant safety checks in it that you could essentially implement in a risk-free manner where that's very low cost. So I don't think that's in the next 3-year horizon, but it is certainly possible in the future. So I think it is always good to just periodically evaluate things. And it's also very good the same way we were talking about it from the performance and strategic allocation perspective to see what your peers are doing, to constantly be on that journey of self-improvement and learning from other organizations as well, I think is just a helpful, good practice.
Fair, thank you.
Thank you, Trustee
And
Langton. Go ahead.
I just have a couple more. So is it worth saying before you delve back into a reevaluation, maybe having some more support for it? Just because this was not a quick, set of slides to create. I mean, I'm sure you put a lot of time into it, and I feel like unless we do have an AI option, which is totally right on, thank you for that. I just don't see us going back. So I don't want to say come back after this next strategic allocation for no reason.
I think in this analysis and building on the previous ones, we've set a good framework to how to approach it. So really it wouldn't be as intensive going forward. And so it probably makes sense to just revisit it with some updated numbers as things change in that aspect of it. But I think we build out a pretty robust background for evaluating it going forward.
And I think Tim said something to consider that part of the process is also a learning process. So you get a chance to go compare peers. So there's some insight that can potentially be drawn out to the process. If I get the genesis of your question. Trustee Me.
Thank you. So actually at the same point, I really appreciate, opposite point, I really appreciate this reassessment because the point I already got hit multiple times, the variables are changing every day, the environment changing every day. And then it's important that we reassess, find that confidence in our operational model, right? If you look at the pension fund, they're pretty much split in half and half. Some operate this way, some operate this way. They both, find their own way of success. And then it's important that we reassess to find what's fit for LACERA specifically. So I appreciate that reassessment. I think it's necessary. And then I do find confidence that we are at the right, business model, operational model for LACERA with the situation that we're in. So, with that said, I just want to say thank you for the study, and it also helped me understand when I go to conference and talk to other pension fund, other trustee. I always ask that question like, how big is your fund, and how many investment staffs do you have, right? So I try to make a sense of that, and then now this add to my understanding. It's not a straight correlation because the operation model could be differently. So if they're without internal investment model, they would probably need less of staff. And then if they have internal management model, they have a much larger team, even though the fund size might not be that much larger. So that helped me to confirm the understanding as well. So I just want to say thank you.
Okay, thank you very much, team. Appreciate it. So just so you all can mark your calendars or perhaps anticipate a bio break coming. We have under reports, we have a presentation by Christine and Susan on legal transactions report. And then we'll pause for a bio break and then we'll transition from there. Oh, yes, right. Do we need to, oh no, the recommendation was for the. No, it wasn't a recommendation. It was just, yeah, just part of the process, the rhythm of the process. Yeah. Okay. Welcome, good to see you again. All right, Christine and Susan.
Good morning, Mr. Chair and trustees. I'm Christine Roseland, Senior Staff Counsel from the Legal Division. In your board packet, there's a report setting forth the accomplishments of the transactions group for calendar year 2024. My colleague Susan Wang to the right of me, and I would like to provide you with a brief summary of that report this morning and give you some context as it relates to the charts and graphs contained in that report. As you'll see, the charts and numbers are a reflection of the investment division's priorities and focus for the year and are closely aligned with the initiatives approved by this board when their work plan is presented in the beginning of the year. Similarly, our work on commercial agreements is reflective of LACERA's organizational priorities and the various initiatives being driven by the executive office. First, we'll start with who we are and what we do. The transactions team is part of the larger legal division, which also includes teams dedicated to benefits, disability, litigation, and employment. Our transactions team is one of the bigger teams within the legal division and is comprised of 4 attorneys, 2 legal analysts, and 2 secretaries. 1 attorney is focused on commercial transactions and Public Records Act requests, and 3 are dedicated to investments. 2 of those 3, including Susan, joined LACERA only last year as we filled several vacancies prompted by departures and added positions in response to a large volume of work. We also have 2 vacancies that are currently filled by temps and returning retirees, and we hope to fill those soon.
Good morning, Mr. Vice Chair and trustees.
Make sure your mic is on, Susan. Yep.
It looks on.
It's on. I turned it off.
All right. Yeah, you want the red thing off. There you go. You're good.
Okay, sorry.
Yeah.
Good morning, Mr. Vice Chair and trustees. I will now provide a high-level overview of what the transactions team does. The team is responsible for supporting the investment division as well as other LACERA departments with their transactional legal needs. This support is comprised of drafting, negotiating, and reviewing agreements, as well as providing advice and general problem solving, drafting policies, and protecting pension assets from excessive risk and liability. The team also supports strategic initiatives around the organization, including LACERA's 5-year strategic plan, as well as investment initiatives such as growing the TIDE program, increasing operational effectiveness, advancing technology innovation, and updating policies and procedures. As you'll see on this chart, the total number of projects completed during this past year, not including Public Records Act requests, is 566, which represents an aggregate contract value of $8.8 billion. This represents a 29% increase from last year in terms of volume of transactions. Much of the increase in numbers have come from public markets, credit, and real assets. First, although public markets did not allocate new funds in 2024, the engagement of 2 managers that focused on emerging managers during the prior year in 2023 resulted in additional legal work, including opening sub-accounts in international markets for those managers. In addition, there were multiple requests from managers for tax documents. Similarly, additional legal support was required as the credit team continued to build out its dedicated managed account, or DMA, platform and onboard new managers to the platform. Finally, as the newest asset class, the real assets team continued to allocate funds to new managers and establish co-investment opportunities with them in order to meet their target allocation, which resulted in increased legal activity. These activities are reflective of the broader investment initiatives and work plan for the year, which include the following: optimizing investment models by saving on fees through co-investments in the credit DMA, as well as through other alternative structures, such as secondary sales to focus on strategic relationships. Maximizing stewardship by monitoring the portfolio for ESG risks through arrangements that provide additional reporting from managers. Increasing operational effectiveness by transitioning from the separate account real estate program to a commingled fund portfolio that increases diversification and reduces operational risk. And continuing the TIDE program by identifying and investing in emerging managers and expanding the asset classes that do this.
When we step back and look at these charts and numbers collectively, the following trends emerge. First, we're seeing increased complexity in both investment structures and compliance issues. 10 years ago, the majority of our portfolio was managed under straightforward investment management agreements. Today, most of our investments are in alternative structures, which require significantly more complex legal documentation. These include delegated management accounts with fund of one structures, limited partnership agreements, co-investments, secondaries, and revenue share agreements. Each of these structures brings added layers of legal review and negotiation. With this complexity comes a parallel rise in compliance requirements. Regulatory changes, such as restrictions on certain kinds of stock ownership, and a noticeable increase in requests for know your customer and anti-money laundering rules documentation have resulted in more legal involvement. Additionally, we must closely monitor material non-public information shared with staff to ensure proper handling and compliance. The second trend is the growth of both the pension plan and the OPEB trust over the past 5 years. More assets often mean new allocations and the onboarding of additional managers. Each new allocation or manager requires legal review and support, which naturally increases the demand for our team's support and services. In parallel, LACERA as an organization is undergoing its own transformation, guided by the priorities in its 5-year strategic plan. These priorities, such as technology innovation, enterprise risk management, and investing in people, directly generate additional legal work. For example, technology innovation often requires commercial contracts to bring in new IT vendors, while investing in people involves contracts for HR vendors and recruitment initiatives. Public Record Act responses are another area worth noting. While the number of requests has remained relatively steady, their complexity has increased. Many now involve broader searches, more tailored responses, extensive redaction, and additional communication to isolate truly responsive records. This translates into more hours of work per request, even though the total number of requests has not risen. Looking ahead, we expect these trends to continue. We foresee a sustained higher demand for legal services, an ongoing focus on compliance and risk mitigation, and continued legal support for both organizational and investment initiatives. And this concludes our presentation, and we're happy to take any questions if you have them.
Thank you very much, legal transaction team. That's great to hear that. I know Stephen has talked about it before, the transaction team. We've never had a chance to see you guys come forward, at least not the 4 or 5 years that I've been here. I apologize if I missed one, but it's just good to see the transaction team, and the report was appreciated. So thank you for putting that together. Any comments, Trustee Me?
Thank you. I do have a minor comment. Thank you for the presentation. Lovely meeting to you all. How many of you in transaction team?
Well, so there's 4 attorneys, 2 legal analysts, and 2 secretaries.
That's not a lot in comparison to the down amount of work. So there's a little bit concern on my side. How are you guys doing? Do you need more resource? I hope nobody's born out because of the workload. Hope you're enjoying it. How's everyone doing?
We do keep quite busy, and we always confer with Steve about our needs. So I think, Steve is managing that.
Good. Yes. Thank you. Just want to, ask that. Thank you again for Steve, your leadership, and the team for the amount of work, excellent work they have been doing. Yeah, that's all.
Thank you.
My colleagues, anything? Okay, super, thank you. So let's take a 5-minute pause for bio purposes. Let's make it 10, actually. So we'll come back at 10:40.
Recording stopped.
That should be over.
let's bring this back to order.
That's a pretty good number.
We should be transitioning into executive session pretty quickly here. But as of right now, we're on Title IX. Ms. Linda, any items for staff review?
None.
Being none, any items for future agendas?
Nope.
And then for good of the order, let's let our CIO kind of kick it off. I know he's got a couple special acknowledgements, especially that he'd like to make.
Thank you, Mr. Vice Chair. A couple of things. One, in terms of the Sharpe ratio, just wanted to get back before the end of the meeting. And it was just shared that over the last 10 years, our Sharpe ratio, which is a measure of risk-adjusted return, is in the 9th percentile in our peer universe. So I think that shows the quality of the returns that we're generating. The other thing is, as I was listening to the legal transaction report, it reminded me of all the times I've had to sign documents. So I think that's something that should be appreciated, is with each of those transactions, there's multiple signatures. So, and my hand's tired thinking about it. A couple of announcements. First, want to provide a welcome to the team. Beginning this fiscal year, and we started towards the end of last fiscal year, we started a LACERA fellowship program in the investment office. And the fellowship program is for more recent graduates to enter the investment field and to do so at LACERA, and to have a 2-year rotational program, with the first year being in our portfolio analytics group, getting broad exposure to everything that we do, and the second year to be moved into an asset category group for more specialization. We've have in the budget for each year for us to add 2 people, 2 fellows, and I'm really excited to introduce the first of our fellows in our inaugural fellow class, and that is Jesse Gonzalez, who I'm really excited to welcome Jesse to the investment team, to LACERA. Jesse is a graduate of Cal State Long Beach. He joins us from Airgas, where he worked in a variety of operational as well as inventory and credit types of roles. I think it's fantastic experience. And I admire that which Jesse does outside of the work to kind of pay it forward. I know that he's a mentor in Big Brother and Big Sister, which is a fantastic organization, and says a lot about Jesse and what his focus is, and you know, his kind of his ethical makeup. So with that, just want to welcome Jesse to the team and look forward to a great couple of years.
And I hope the hazing ritual is not too intense.
There's none. So, and with that, I would like to, for a while, LACERA, the investment division, for a good decade plus, we've had, I think it's a decade, an internship program. We used to have MBAs as interns. We've moved to undergraduates as interns. We have had different numbers of interns. We've had interns during the semester, during the summer, and we think we have a pretty good model now where we have 4 summer interns, 2 that we work with Girls Who Invest, the other 2 through SEO PRIA. And this summer, Magdalia Armstrong has taken the lead on running our being the point person on our internship program. So if it's okay with the Vice Chair, I'd like to ask Magdalia to come up to introduce 2 of our interns who are with us. The other 2 have kind of, their summer has ended, but Magdalia will take it from here.
Thank you, John. As John mentioned, I am Magdalia Armstrong. I'm with the growth team. So we just wanted to take a moment to introduce our summer interns. And as John mentioned, we had 2 summer interns with SEO PREA, and SEO is an organization. It stands for Sponsors for Educational Opportunities. PREA is the Pension Real Estate Association Foundation. and they partner together and create this real estate career track for interns. And obviously Girls Who Invest, all great organizations looking to enhance industry knowledge of these young students, and so they can excel in the industry. Our SEO PREA interns finished their term last week, as John mentioned, and we had Juan Quevedo, who's a rising junior at the University of San Diego, and we had Susan Wong, a rising junior at UC Berkeley. So they have gone back home before they start the new school year, and we wish them well in their upcoming year. And we thank them for their time here. So today we have, please come on up. We have our 2 interns with Girls Who Invest. And I just want to say that, I had the great pleasure to onboard and work with all interns, as well as my colleagues, working with them and getting to know them and integrating them into the team was a real great pleasure. So with that, I'll turn it over to each of them and they can share a little bit about themselves. So thank you.
Thank you.
Hi, my name is Nada Ali Hamati. As Magdalia said, I'm a rising junior at the University of Arizona. I was placed here with Girls Who Invest, and I'm super excited to be here. I've learned so much this summer about so many asset classes that I had no to little knowledge about. But yeah, so thank you. Hi, everyone. My name is Paulina Mora. I'm a rising junior at Claremont McKenna College, also with Girls Who Invest, and we were both placed here at LACERA. So far, it's been a really great experience. We were told to share one thing that we have learned so far in our 7 weeks here. And I think that one thing doesn't suffice the amount of things that I've learned. So maybe I'll give 3 things that I learned. So I think I was able to work with the private equity team and I was able to kind of research the risk metrics of potential commitments. I was also able to work with the global equities team and kind of investigate a little bit more about investigate more on emerging markets for global equities. And I've also, with Netta, worked on a QPR project and trying to standardize a template for all of the different asset classes, despite their difference in nature. So I'll definitely take all the things that I learned and apply them to my future career or any endeavors that I choose to take on. So thank you guys so much for having me today.
Thank you. One of the things that I enjoyed, hold on, there may be a trustee question or two, but I just want to preface this just by saying that while I was chairman last year, I had the pleasure of having lunch with 2 from Girls Who Invest and the other 2 from SEO. I also teach currently, so I'm around young people all the time. But it's just great to see their minds turned on. It's great to see that the nature of our culture is also very accommodating to youthful explorers within the industry, giving them real work, real challenge, showing them what the kind of threshold professionalism that's required to be successful in this field. So they walk away, whether they're determined to be in public pensions or not, but just with a lot of things that kind of help carry them forward. So I'm very proud that we make a commitment as an organization to accommodate them in doing such. But yeah, let me open this up because I appreciate the things that you learned. But are there any trustees that have any questions or any things they'd like to hear our interns comment on at all? Okay, yeah, go ahead. Trustee Lincoln.
Just wanted to thank you for applying. I'm so thrilled to hear that you had a great experience, and that says, a lot about LACERA. That thank you to all of you for giving them that amazing experience, and do apply again.
Thank you. Well, I will take the prerogative and just ask you each one question, right? And you can both answer the same question, which is when you go back and you share with your peers the experience you've had this summer, what will be the one thing that stands out the most to you about it?
Yes, great question. Thank you. I think so far, I think this was probably the first opportunity that I had to have like a real in-person summer internship. And before that, I would hear upperclassmen talk about their experiences. But I think something that I never really heard them specifically talk about was the purpose. Like, yes, you're interning at these banks, but what's the greater purpose of what you're doing? And I think here at LACERA, something that is constantly reiterated from all of the different employees that I've been able to talk to is that they do it for a greater purpose. They do it to serve the Los Angeles County employees. And I think that that's something that I haven't heard from any other students at my school talk about. What's their purpose? Who are they serving? So I think that it's something really unique, and I'm so glad to have learned throughout my time here.
Thank you for the share. That's great.
Okay, something that I'm definitely going to take away is going into college. My background in finance is very limited, and I thought it was working at a big bank or nothing, like working on at a company with like 90,000 people or literally nothing. But being here and seeing how kind of like close knit that the investment team is, I feel like that's definitely my biggest takeaway. And I think moving forward in my career, whether it be at a pension plan, pension fund, or a bank or an investment bank, or whatever it may be, I do think I really enjoyed the close knit, the small team, because I feel like it's easy to, I guess, form a relationship with like your peer or coworker. So that's definitely my biggest thing that I want to take away is that close knit, small teams could also be just as powerful as the big ones.
Thank you very much. Thank you guys. Appreciate it. Anything else while you have the floor on the go to the order?
Just a shout out to Magdalia for all the work
Thank you.
this summer. Thank you, Magdalia.
All right. You want to otherwise go down the list?
Sure. Ms. Langton.
Thank you. Thank you, everyone, for your presentations today. Welcome to Jesse. Good to have you. Coming back around, a huge thank you to Linda, who has now taken on 2 boards, arguably 20 trustees. I'm sure we drive her nuts, but she does an amazing job, and she's always very patient. You get a smiley face with every single text and email, and it's really nice to work with her. So thank you to Linda.
Thank you. Mr. Rue.
Welcome to the interns, and I thank you for our staff for all your hard work.
Thank you, Ms. Mee.
Thank you. I have amazing day today. It's such a beautiful story about intern and growing investment, right? I'm coming from an industry that's male-dominated industry in engineering. It's not easy. And then I come to this investment industry, realize it's the same. Women are underrepresented. However, look at what we do in LACERA here. We're mentoring, helping intern to grow. Look at the speaker earlier, Pure Capital. They come from our immersion manager program. And as a women founder, see how far they have gone. And we are part of there to supporting them become who they are. So I always say that there's no lack of talents in women. What lack is opportunity. Right, so we're doing a fantastic job here that made me want to share my experience of last month of speaking at Thai Spa conference. I got the privilege to share, what we do at the conference, a place that organization is sharing similar values, in Thai. And then it's important we'll be there and then emphasize the voice, right? And then I was there sharing what we do from the staff level, right? Our investment belief, we believe in diverse talents will result in enhanced outcome. And then look at our investment team. We don't just say it, we're doing it in every level. We have very diverse group of talents investment team. And that, is a core, maybe it's a secret sauce of our success, right? The talent there. So on the other hand, besides the team, the members, the Thai program, right? We're holding our GP accountable. Right, we raise those questions, score them, bring them back to have a conversation with us. So that's a very successful program there, and we're helping to change the environment in the industry. And then the last point is I share is that the board, we're doing great in the teams. We're doing great holding the manager accountable, helping the talents to fly there. Look at our board. Look at our board today in comparison to just 2 years ago, how much we have changed, right? How much more diverse we have become. And thanks to the leadership before us that their consistent effort to get to where we're at today. And then now it's up to each one of us in the leadership position, what we do to, what we're gonna do to take it to the next level. So yeah, I just want to share that. hope is a really important thing. I'm glad, LACERA can be the hope, can be the light out there for people. And then I hear a story from the conference too, that a female founder come to me and she said, Nicole, there are plenty of women in investment manager there, very experienced, very talented, but they're afraid to spin out to be a founder because they don't think the environment supported enough, for them to be successful today. So I think hope is such a critical thing. I think we can be that hope for people like that, for talent like that. So yeah, that's all I want to say. And today I want to a great meeting. Thank you for sharing the year-end performance. Very excited. And then thank you for all the great work everyone does here. That's all.
Thank you, Mr. Gatto. Okay. Ms. Ginsburg. Okay, Mr. Jones.
Okay. Other than thank you, staff, for a great meeting. We have executive session coming up for all of those of you who may be about to go through. And I remember Christine talking about this with you at one of the conferences that we happen to be with. But for those of you that are about to go through separation, drop-off anxiety of your child at school, college for the first time, I empathize with you. But as you can see from the young people that were before the mic here, it will be exciting to see the transformation over the next year, 2 or 3 or so. So with that, let's take a break for executive session. Thank you.